Family income splitting strategies that will put more money in your pocket. The following video contains information only and must not be considered as tax advice. The Canadian income tax system is considered progressive. In other words, the more money you earn, the more tax you're expected to pay. Individuals are encouraged to explore all legal strategies to reduce their payable tax. Family income splitting has been a vehicle for individuals to reduce their tax obligations. There are, however, few rules that hinder family income splitting. Rule number 1. No joint tax return filing. In Canada, there is no so-called joint tax return, where a husband and wife file a single tax return. Each individual must file their own tax return based on his or her income. Rule number 2. The kiddie tax. Certain specified incomes are taxed at the highest possible tax rate. Rule number 3. Income transfer between spouses. Money cannot be transferred between spouses in an attempt to reduce the tax obligation of the higher income earner. Rule number 4. Income transfer between parents and minor children. Money cannot be transferred between parents to their minor children in an attempt to reduce the tax obligation of the parents. So if all of these rules are in place, then what can a person do legally to reduce their tax obligation? Please note that all the following options are to be done very carefully only after reviewing your specific situation with your professional accountant, such as Numbers Plus, as errors in any of these strategies could have significant negative consequences. There still remain strategies to split family income that can assist you in reducing your tax obligation. These strategies may or may not apply to your individual financial plans or goals. Family income splitting strategies. Strategy number 1. Tax-free savings account, or TFSAs. A TFSA allows individuals older than 18 years old to receive $5,000 of TFSA contributions each calendar year. There is no tax deduction received on this money, but the money is not taxable when it's withdrawn. Strategy number 2. Loans to a spouse or children. Loans can be made to spouses or children as long as the spouse making the loan charges an acceptable interest rate to the spouse or child receiving the loan. The child or spouse receiving the loan must own the investment portfolio and pay tax on the dividends paid. They must also show proof that they have paid the acceptable interest rate to the spouse loaning the money. Strategy number 3. Investment of funds by lower income spouse. Loans can be made from a higher income spouse to a lower income spouse, provided the lower income spouse uses the loan for investments. The lower income spouse will be taxed at the applicable rates, but a permanent tax savings can be achieved. Strategy number 4. Employment of a spouse or children. If you own a small business or are self-employed, then this strategy can help you keep the money in the family. You have the opportunity to employ family members that can do the work. You must pay your family member at a rate that you would pay a non-related individual, and you must follow all of the usual obligations as an employer. Strategy number 5. Pension income splitting. This is an effective way to minimize tax but can only be used on private pension plans or personal RRSPs. Government-sponsored plans such as CPP or OAS cannot be split among spouses. Strategy number 6. Credit transfers. There are a number of non-refundable tax credits at both levels of government that are available to each individual filing a tax return. In a family, if one spouse has already used a number of credits to reduce their tax payable liability, then the other spouse can use any remaining credits to reduce their income. In addition, expenses can be grouped together, such as charitable donations and medical expenses, and claimed by one spouse or split accordingly. Children can transfer their school tuition and education expenses to one of their parents. The strategies outlined above give a family legitimate ways to reduce their overall tax liability. As mentioned, these strategies can be maximized according to your personal financial goals. Call us at Numbers Plus today, and we can give you an assessment on how to deploy these strategies and put more money in your pocket.